welcome to the Hardcore Finance Show. Today it's a solo episode by me because Alex couldn't make it due to some personal commitments, but we have an exciting topic to talk about, which is how the Fed's Jackson Hole meeting tanked the markets. And so basically, for those of you that are not caught up on the news, the Federal Reserve had a meeting. It wasn't an official interest rate decision meeting, but it was pretty important because, you know, people really want to hear what the direction is and they speculate on the direction. And basically the Fed said, look, we're going to keep increasing interest rates until we get inflation under control. And that is, seen as a sign of they're not going to pivot anytime soon. So that tanked the markets hardcore. In Friday, I think the NASDAQ went down by more than 4% in one day. And that is because basically the interest rate is, you use this to discount the cash flows of companies. So like if you make money today and then next year and then the year after that and so forth, the money that you make 3 years from now is worth less. Because you could have invested, money today to reach that amount to make it equal. And so the higher the interest rate, the lower the valuation of stocks. And that's just a simple one way of looking at it. Another way to look at it is that the cost of capital, when it's higher, then companies can basically, it's harder for them to borrow and invest in profitable projects. So if you can borrow money at 1%, there's a bunch of things that you can do that will give you more than 1%. And so you make a profit. But if you borrow at 3 or 4%, there's less things that you can do. So those are the two ways to see why an increasing interest rate is bad for stocks. But I wanted to zoom out a little bit and present a different, more holistic view of what the Fed is doing. And the way I look at interest rates is basically the Fed is paying what's called a Fed funds rate. So it's like if banks deposit money at the Fed, which they have to do by law, a certain percentage, that's the money that the Fed, pays those banks to keep money with the Fed. And so that means that a lot of the money is kept there and not in the economy. So that's why when you lower interest rates, when the Fed lowers interest rates, it creates a higher velocity of money into the economy. And, people basically spend the money instead of investing it. And by the way, one thing I forgot to mention is that the Fed funds rate basically has a direct implication on all of the other rates in the market, like the mortgage and car payments and credit card interest rates. They're all a function of the risk-free rate. So you can think of it, for example, a credit card, because you can just default on it, it has a high premium over the risk-free rate of the Fed. A mortgage, you have a lower likelihood of defaulting on it because, you lose your home and you lose some of the equity that you've built in the home. So that's why the interest rate is lower. And a car is kind of in the middle. So basically, what is the meaning of raising interest rates beyond just tanking of stocks? So think of it as a reservoir that can hold, we pump water from the ground and we can either send this water to let's say irrigate fields, or we can store some water in the reservoir. So when the Fed increases interest rates, it the analogy is that more water is stored in the reservoir. And so basically it makes two things. One, you could say that it's good for longer term growth because this reservoir of water, we can use it next time that the economy starts hurting. So they can lower the interest rates. And by lowering the interest rates, it really, really stimulates the economy. Now, when you think about it, when the interest rate was zero, we knew that they cannot do anything. They can't lower it below zero. The real interest rate is already negative. The real interest rate is the difference between the inflation and the interest that you get. So if we have an 8% inflation and a 3% interest rate, that's basically a negative 5%. So you lose 5% of your money every year as long as the inflation is 8% and the Fed funds rate is 3%. So basically, when it's zero, people say there's nothing the Fed can do. And so that's why they maybe don't engage in behavior that could be risky, but that could also be rewarded, and it can create growth. So that's one way of looking at it, which is like, it's almost like building an arsenal of things that you can use to stimulate the economy later on instead of stimulating the economy now. Another way of looking at it is, remember how I mentioned that with a high interest rate, you have less projects that you can do? It's like, on the one hand, you have less projects that you can do. On the other hand, now you work really hard to find those projects, right? You basically, companies that are able to find those projects, they will survive. And companies that are not able to find those projects, they will not survive. They will go bankrupt. That's if you don't have any debt. If you have debt as a company, then you're really screwed, because like a higher interest rate means that the next time you roll over your debt, so when you basically raise new debt to pay off your previous debt, which is what companies do all the time, you will have to pay a lot more for the same debt. Like a way to think about it is like, think of a mortgage, right? Like if you have a house and you have a fixed fixed mortgage rate of like, let's say 3%. If you have to move now into a different house and get a different mortgage, suddenly your monthly payment is much, much higher. So you can afford a much smaller house in the same area, or, a house same size in a worse area. But the point is, once you do this, you can then refinance your mortgage when the interest rate goes back down. So like, even though it basically makes you be more frugal as a household, it makes you be more to work harder as a company, to maybe like not hire as many employees and to like demand more productivity from employees that are already there. And that overall is better for the health of the economy. Like if you think of like most people, what they do, the average company or the average consumer, because of these higher interest rates, they will change their behavior in ways that are better for the economy, right? In the crop analogy, right? If you now have less water, because like some of the water is going into this reservoir of the Fed's, Fed funds rate, then maybe you grow better crops, or you find out better ways to irrigate your crops with like less water. Or you find some crops that require like less water, but you can sell them at the same price. So basically it forces you to be more efficient. It forces you to be more productive. The way the Fed thinks about it in macroeconomics, they basically say there's the neutral interest rate, which is a theoretical concept, which says like, if the interest rate is at that level, unemployment would be at a good spot and growth would be at a good spot. If the interest rate is above the neutral rate, then things go into a recession. And if the interest rate is below that neutral rate, we get inflation. So what they're trying to do now is to go above the neutral rate to put, to basically tame inflation. That's like their number one goal now. So if things are so good for the economy long term, what are the problems that could be? So the biggest problem would be, what would happen if the Fed just kept the interest rate high, right? And if it didn't lower it later on. So that would be really bad, because that could mean that the whole stock market is repriced at the higher interest rate, which means the stock market would be lower for a very extended period of time. So that would be a very bad situation as an investor in the stock market. But I don't think that could happen. I don't think that could happen because mainly the government has a lot of debt, right? It has debt, probably one of the highest points in history. I don't know exactly, but the debt to GDP ratio is very, very high. I think it's 130% for the US, and globally it's even worse. Now, what happens? Two things would happen if the Fed did not lower interest rates in the future. I'm not saying when, but at some point, right? One, the government will have to like cut back services big time, because they're basically, when they roll over their debt, they'll have to pay more in interest. And so they'll have less budget to use for like social services, for education, for the military, for, Medicare, Medicaid, all of these things. If the interest rate remains high, they will have less money to spend. And guess what? That's not popular with voters, right? And the Democrats, they want to, not get a really, really bad outcome this midterms. So I think what the playbook will be is that they will be very, very hawkish now in Jackson Hole, so they could start pivoting next meeting, which is like end of September. So the next meeting is end of September, and then the midterms are pretty close afterwards. And it's not like the Fed can just announce something and the economy immediately rearranges itself, right? It needs some time, I think, to give good economic results before the midterm. So what I think is that the Fed will definitely pivot kind of soonish. But even if it doesn't pivot soon and Republicans regain the Congress, because the results are bad, what do you think Republicans are going to do? Like, they're going to, either pressure the Fed to lower interest rates, or at least not spend any more money, or basically they'll have to pivot at some point. So that's one. Then the other thing is that the dollar is really strengthening because we are raising interest rates while all the other countries have lower interest rates than us. And so then what happens? If I'm an investor in the third world, let's say, and I can choose, where do I park my money? I could park it in euros, I can park it in dollars. And the dollar pays me a higher interest rate. So like I will buy dollars. And so that's why the course of the euro dollar has been tanking. So like it was like $1.2 per euro several months ago. Now it broke one. So it's below one. So like €1 is worth less than $1 now. That's kind of crazy. And so that cannot be sustained for a very long time, because what happens is if the dollar is really strong, all of our exports are going to get hurt. Because like, just think about it. If someone in another country pays for American stuff, suddenly everything became 20% more expensive over the last couple of months. So what does that mean? You buy less, right? If the price goes up, you buy less. Suddenly other countries can outcompete us. So let's say you had a US company and a Chinese company giving a bid to build something in a third country, let's say an airport. And you're like, okay, all things considered, let's say the quality is the same, even though the US has a premium, but just for the sake of the exercise, let's say the quality is the same, you will go with the US because, you prefer to work with the US. Suddenly, if the US bid became 20% more expensive just because of exchange rate, then you would choose the Chinese thing, and so then it would tank the US exports. So it makes imports cheaper, it makes exports more expensive. And so I don't think that could be sustained in a very long time, because exporting stuff is really important for the US. So that's one thing. And then the other thing is, you could say maybe the US can pressure other countries to also increase their interest rates. And so basically to say, okay, no reason to park it in the dollar, because like if the dollar pays 3%, maybe the euro can pay 3%. The euro can never pay 3% because their debt situation is even worse than the US. So I mentioned before that the US has like something like 130% debt to GDP. The rest of the world, if you take all of the world combined, is something like 300% debt to GDP. So that means that they can definitely not pay more interest rates. And if you think about it, for every increase in the interest rate, the US is hurt less than the rest of the world, because it has less debt. So Europe cannot do it, and I really think that basically the only solution for the Fed is to pivot, lower interest rates. And we'll see when it happens, but that's why I'm optimistic with regards to the stock market, because even though now it's a very bad time, first of all, I think they'll pivot back. Second of all, I wanted to show you the long-term trend. I'm always a long-term guy, and I think that basically whatever is happening with the with the economy can deviate from the long-term trend for a short period of time, but over the long period of time, we always kind of revert to the mean. And the mean is that tech is a force of good in terms of productivity. Tech allows us to do more with the same unit of capital, right? Like the best example is like, think of one of these like huge harvesters that can basically take like a satellite image of your crops, understand exactly where the crops are missing some kind of nutrition or some kind of fertilizer, and as it harvests the wheat, it can drop exactly the right amount of fertilizer on a GPS map. I've seen one of these. I've actually gone on one. It's incredible. These things cost like $1 million for like one harvester, but just think of how much more it would cost if you had to like fertilize the entire field without measuring it, or have like tons of people doing the manual labor of harvesting the crops. And so basically per amount of capital, per every dollar spent, we get more productivity today because of technology versus what we would get like, let's say 100 years ago. So if you project that into the future, that's what the NASDAQ gives you. The NASDAQ gives you the overall increase in productivity. And yes, sometimes it can get overheated. Sometimes it can get like in a little recession or depression or whatever it is. But I really believe that it always reverts to the mean. And if we talk about crypto, right? Crypto too, there have been a lot of projects that frankly didn't make a lot of sense. So like a lot of capital was invested in projects that like didn't make a lot of sense. Luna, for example, it paid you 20% risk-free. Nobody asked themselves, where does the 20% come from? Because like you could have like firms like BlockFi, for example, they paid you very, very little. They paid you back when there was like an arbitrage opportunity of GBTC to spot Bitcoin. There was a premium. And so they would pay you like 4%, 5%. And what they would do is like you would give them your Bitcoin and they would lend it to somebody else. That person would use it to exploit the arbitrage opportunity and then give it back to you, right? With interest. So that's clear where the interest came from. It came from an arbitrage opportunity. And guess what? When the arbitrage opportunity closed, now GBTC is at a discount rather than a premium, suddenly BlockFi stopped paying interest. They said, okay, we'll pay you 0.2% or whatever. While BlockFi was paying 0.2% in interest, Luna was paying 20%. And how did they justify that? They said, oh, it's our customer acquisition cost, right? Now, look, that's my profession, to acquire customers. And I can tell you, there's only so much that you can scale with unit economics that don't make sense. So like, for example, Uber, they said, look, we're willing to lose a lot of money to acquire people, because then over time we'll figure out a way to make Uber Pool, and we'll be able to increase the utilization of the drivers and make the drivers more productive. Or afterwards, when COVID came and Uber Pool was canceled, they were like, oh, now we actually have pricing pressure that we can apply. And they actually raised their prices and people got away with it because they were like, okay, I'll pay $1 or $2 more for my Uber ride. It's not a big deal. But those $1 or $2 on the bottom line can make a very big difference. So in certain industries and in certain cases, it makes sense to lose money to acquire customers, but that has to be linked to a plan you have later on how to make money from these people. What did Luna do? They were like, okay, we're going to pay you 20%. That's it. Like, how are you going to make money from these people? Like, the only way that you could get money from these people are from people that come in and join, but like, that's going to stop at some point, right? And you had so many of these projects. You had all these NFTs that are sold at like extravagant prices. You had different platforms that didn't do too much, and they raised capital at huge valuations. Now, if you think about it, what does it mean to raise capital at huge valuations? It means people give you money and they get less of a percentage of your company than if the valuation was lower. So then that basically created like huge market distortions, because people were like, okay, I invested, let's say $100 million in this company, I'm expecting to make a positive return. If before I would get, let's say, 10% of the company for 100 million, now I'm getting 5% of the company for 100 million. So that means that the company has to make double the profit to make things equal for me. And that clearly wasn't sustainable. So what happened is, as the Fed increased interest rates, crypto went down like crazy, because crypto currently is really treated as like a high leverage tech stock, for lack of a better term. And I'm not saying that this is going to be the case forever, but like for now, definitely there's a correlation between Bitcoin and the Nasdaq, for example. So what happened when the Fed raised interest rates? Suddenly the projects collapsed. Lots of people lost a lot of money, but the projects that stayed are much healthier. Bitcoin formed a bottom at 20K. And yes, the current bottom is the same like the previous top, where the previous bottom there was around 3,000 or 3,500 was like 3 times the previous top. So the previous top was like $1,000, then it collapsed, then it went up to 20,000, and then when it collapsed to 3. So like supposedly you could say, oh no, Bitcoin is dying because like this time it collapsed to its all-time high, versus previously it collapsed to a price that was 3 times higher than the all-time high. But to that, my counterpoint is that the previous all-time high at 20K, we barely spent any time there. It was like a wick that lasted for like maybe a week or maybe a couple of weeks. But like the previous $1,000 top, we stayed there for a while. So I would actually make the case that Bitcoin is much, much healthier. We're seeing real institutional interest. We're seeing like funds deployed to, for example, NYDIG is doing like a Y Combinator for Lightning. Lightning is a really exciting layer. So basically, think of the interest rate as a cleansing of the bad projects all across the economy. And so hopefully we can be at a much, much healthier spot. And then hopefully the Fed will pivot, lower the interest rate before the election or after the election, and then everything will keep going up. So I hope this made you a little bit less anxious about what's going on. Please let me know if you have any questions. This whole episode came from a question of one of my family members, so I'm very happy to answer it. And please like us and subscribe. That really helps with the distribution of the podcast. And let us know what you think. So until next time, I hope you have a great week.